Okay, welcome to the November 28th edition of the Fats, Fuels, and Oils webinar. I hope everybody had a good holiday weekend. Just a little bit to go before the end of the year. This week, we're going to talk about what's going on in the soybean market in the US and a little update on what's going on in South America. And then we're going to talk a little bit about the EMTS data that came out not last Thursday, but the Thursday before, and then what that means for our forecast going forward. So let me share my screen. All right. So let's start in South America. It's kind of the same. There's been some improvement in weather conditions in the center west region of Brazil. I think the biggest thing right now is really the planting delays. So if you look at Brazil as a whole country, I think they're running later than they have since 2008 or something. However, that's divided up into center and northern growing regions where it's been drier than normal, and the southern growing region, which has been a lot wetter than normal. And the wetter than normal is sort of dragging down the whole country. And ultimately, that'll have a couple of impacts. One, it will impact soybean yields because later planted beans have less time to develop, and it's excessively wet down there. So a lot of the beans that have been planted probably will need to be replanted. In the north, the concern would be, or north of where it's been excessively wet, the concern would be more about getting additional rain, but the impact of delays in the north would have a follow-on effect on the second corn crop. I know not everybody on this call is necessarily interested in the second corn crop, but just in case you are, typically what happens is Brazil plants a first corn crop, and that's mostly planted sort of in southern or more southern growing areas. And that crop is primarily used for the domestic feed industry. And then the safrinha crop is mostly exported. And so while if you just look at the planting progress for Brazil and you assume, oh, wow, they're really far behind, that means that they're not going to be able to plant corn on time. And then that means we're going to have a repeat of sort of what we saw a couple of years ago when the northern crop, when it was excessively wet in sort of the central and northern growing regions, and they were really late in planting the second crop. And as a result, corn yield suffered. This is a little bit different. So the second crop has largely been planted. There's a little bit that needs to be sort of cleaned up, and I'm sure there will be some replanting in some of the drier fields. But the southern crop, which again typically would go mostly to the domestic feed industry, is probably going to be smaller than it typically is. And that means that Brazilian corn exports probably are not going to be as competitive this year as they have been in the past. That means additional demand for US corn exports during a year in which our balance sheet suggests that the US will build ending stocks pretty substantially. Now, we have relatively low exports built into our balance sheet, and so it doesn't necessarily will raise those, and it'll take ending stocks down in the US, and that will keep ending stocks, not super tight, probably around the 2 billion bushel level, still higher than they were at the end of 22-23. And that's important primarily, as Joao pointed out a couple of weeks ago, for the farmers' acreage selections next year in the US. If US corn exports are stronger than we anticipate and much more competitive in the export market than they have been in recent years, then that will provide more incentive in theory for farmers to continue to plant corn next year in the US. Now, a lot of the farmers' decision about acreage is based on based on their crop rotation. And so you can't plant corn sort of year after year after year, because eventually you'll get yield drag because corn sucks nitrogen out of the soil, and soybeans replenish nitrogen in the soil. And so that's why they rotate crops. And while US farmers love to plant corn, and there is definitely not an adage that's more true than that, the idea over the last couple of years has been, as the demand for soybean oil grows, generally you'll see more soybean acreage in the US, and maybe not less acres in the US, but enough to satisfy the domestic demand and export some. And then Brazil will step up and take some market share from US corn exports. That may not be true this year, and it may not be true in the longer term either, in part because of US soybean exports. And so you can see this is weekly export inspections, and the gray line is this year's weekly export inspections, and then the black line with the white circles is our forecast for weekly export inspections. And already you can see that US exports have fallen off much more quickly than they have in past years. And part of that is due to a reduction in shipments to China. While the reduction hasn't been as huge as would be implied by this chart, there's been enough of a reduction that China has actually started to source soybeans from South Africa, of all places, and will probably take not a lot of soybeans from South Africa, but this is the first time that they've ever bought soybeans from South Africa. And it suggests that this idea that China is going to import the bare minimum that they can from the US, partially because of the economics from importing from the US, partially because there still is probably a little bit of political tension between China and the US, and then also partially, of course, because US crushing demand is stronger. And so all of that sort of adds up to what we thought would be more exports out of Brazil, and that part will be true. But China opening up, I guess, relationships, or at least buying relationships with exporters in South Africa, suggests that in the longer term, they think that the US export, the supply that's available to export, is probably going to continue to shrink, and they're going to need as many other sources of soybeans as they can possibly get in order to meet the needs of their feed industry. And so again, while the South African totals aren't that significant, it's more representative of the change that's going to happen in the market over the next couple of years, 3 to 5, whatever it is, where US broadly and to China specifically is going to export fewer soybeans and crush more soybeans. And so China will need to import more soybeans from places outside of the US. I thought that would be basically strictly Brazil. However, it looks like they are going to try to, as they usually do, they try to maintain some optionality in where they source commodities from, because they are extremely sensitive to famine because of their history. And so even if it's just a little bit from South Africa, the fact that they've got another source is probably important to them, and probably means a lot to them. So that is going on, and that's sort of one half of the outlook for US crush picture, where really the crushable supply is kind of a function of whatever production is, of course, carry-in and imports, which are both relatively small. And then the whatever's been exported, everything that's left over obviously is for crush. And so the slowdown in exports means that there will be more soybeans available for crush. And in fact, what we've seen in the crush data for the first 2 months of 23-24, the fats and oils report for September and then the NOPA report for October has been US crush setting records, essentially. One of the things that we've talked about and one of the questions going forward is how strong will soybean meal demand be? We look at it a lot domestically, but what this chart shows, and it's a little funky, but what it shows is the combination of soybean and soybean meal exports if you converted meal back into bushels. So the soybean equivalent in soybean meal exports. And you can see we're kind of in line with last year's pace in soybean and soybean meal exports. Or I'm sorry, we're well below last year's pace, but we are in line with sort of the 5-year average. And I think that slowdown, as shown in the previous chart, has a lot to do with the decrease in soybean exports, less to do with the decrease in soybean meal exports. While we're not at this point yet, we do still believe that there will come a time as oil share rises that US crushers will crush soybeans to meet oil demand, and then they'll have to figure out what to do with the excess soybean meal that's probably going to find its way into the export market and start to show up on this chart. And so whether that is this year or a year from now, it's going to happen at some point, or at least I believe it is. I've been saying it's going to happen for 3 years now, and it hasn't quite happened yet. But at some point, unless there's a dramatic change in US biofuel policy, that seems like it's going to happen. So that really kind of leaves, if we sort of assume that soybean meal export demand or the supply that gets pushed into the export supply chain is going to be at or above last year's totals, I think for every year going forward for sort of the foreseeable future, for the next 3 to however many years. And that means that if we have strong domestic demand, then whatever that exportable surplus is probably shrinks a little bit. And conversely, if we have weak export demand or weak domestic demand, that will increase and it will put pressure on soybean meal prices. Another thing that we've seen is an increase in world rapeseed consumption. And excuse me, this makes sense. And I think excuse me 1 second, I'm just going to mute so I don't cough in everybody's ear. I'm sorry about this. Hold on. Sorry about that. Okay, so the increase in rapeseed consumption is also reflective of a trend that we think probably is another one of these sort of 3 to 5 year trends. So rapeseed meal typically has been something that the US dairy industry has been the primary consumer of, because there are some studies that show that rapeseed meal helps with milk production, helps raise cows' milk production. However, if you think about it, given the amount of oil in a canola seed relative to the amount of oil in a soybean, there is a good reason to crush more canola just to produce the oil. And then if you are the US, you can consume that oil either in biofuel production or in the food industry. But then you come up with this, again, this idea of, well, what do we do with all this meal? And if the US and Canada are producing more rapeseed meal than US and Canadian dairies can consume, they're going to have to find export markets for that meal. And I think that's what's happening. I think it's probably a little bit of a preview of what's coming to the soybean market. And so the reason that canola is ahead, there's two reasons really. One, it's the relative amount of oil in a canola seed relative to soybeans. And so it given a world that is structurally short vegetable oil, you would want to crush more canola than you would soybeans, because you would get more oil from each individual seed. And then beyond that is the idea that as you do that, and as you crush canola for oil, and canola crushing for oil has always been more of, well, oil's always been more of a driver for canola than it has for soybeans. But as you crush more canola for oil, you have to figure out what to do with the meal. You fill up your domestic market and then you export the rest. And I think that's probably why we're seeing the increase in consumption worldwide. And I think that it won't only be, eventually it won't only be rapeseed meal where we see this, but it will also be price pressure on protein meals more broadly. Will, one, increase the consumption of protein meals, two, provide some competition for soybean meal. So whenever I talk about this, I always kind of say like, yeah, we're going to start to crush relative to oil demand, and then we're just going to push the meal out into the export market, and that'll absorb it at whatever price. However, the difficult part is the whatever price part. And so if all of the soybean oil, or sorry, all of the soybean meal that needs to be exported is not only competing with other soybean meal, but also competing with less expensive protein meals, then it makes crush margins generally lower than they might have been otherwise. And that is something that it's going to cause some changes in both U.S. crush margins and U.S. crush demand, oil supply, and it's going to have a lot of impacts throughout the oilseed markets more broadly. And it will impact the value of DDGs and in maybe a very, very small way, ultimately ethanol production, and the value of other protein meals. And so I say all of this not to necessarily point something out that is going to have a huge impact on the markets in the next month or 2 or 3 or 6 months, but something that could have a pretty significant impact on U.S. crushing and the U.S. oilseed market in the next, again, sort of 3 to 5 years. You're going to see this, or the markets are sort of going to undergo this change where protein meal becomes less expensive, but we use more of it. And we, again, kind of crush to the oil demand and then try and figure out what to do with the protein meal. So we don't have a lot of data points on crush so far in 23-24. We have September, which was a record for that month, and we have October, the number based on the NOPA data that we got a couple weeks ago. That implies a record crush for the month, just a record period. And we expect that that will probably quickly be superseded by the November total and the December total. However, if we look at, and I want to sort of focus on this December to February period, and then over here in April and May. So December to February, you can see we're well above last year, 2 years ago, in the 5-year average. As we get into this area, then we get closer and we get a little lower. And that's driven a lot by our expectations for domestic soybean meal demand. You can see that, as we've talked about before, September, August, July, we're all well below last year and relatively low for those months, and where soybean meal demand had been for most of the months prior to that in 22-23. For 23, 24, we expect a little bit steadier demand, still relatively strong. And if this is all true, then the question becomes, how much of this meal demand sort of equates to the oil demand that we see? And so far, we've taken our soybean meal exports a little bit, but not a lot, in part because we have the stronger crush demand for 23, 24 than we had in 22, 23. The decline in prices is part of the reason that we have that. We also just kind of look at hog slaughter and broiler slaughter forecasts, and we really base our domestic soybean meal demand forecast off of those. And so as those change, this will change a little bit. However, we will probably keep soybean meal demand a little bit more elevated than those changes would imply, just because of the anticipated decline in prices. All of that said, soybean meal prices have not been declining at all. And in fact, as we talked a lot about a couple of weeks ago, soybean meal prices have been really high. And part of the reason that soybean oil futures, at least, have been so weak has been because of oil share spreading by specs. And this suggests that that is something that probably may continue through 23, 24. If it does, then if it does, I'm sort of 50-50 on whether oil share gets above 50% or not. I think at some point it becomes almost automatic that oil share has to go to that level. However, given what we've seen and given the way that the market has reacted over the past 3 to 6 months, I would say, I've been more hesitant to forecast oil share above 50% than I have been for the last couple of years. And so, and that's just been because I've done it a lot. Other than one very short period of time, it hasn't really reached that level. And the crushers have been able to provide enough vegetable oil, soybean oil, to meet the demand from biofuel and keep the crush market relatively tight, supporting crush prices. That all is going to need to change. But again, if we get this strong domestic demand in 23, 24, it may be halfway through, or it may be all the way through 23, 24 before we get to that point where oil share really has to rally to above 50% to encourage crushers to provide enough oil for the non-biofuel and biofuel demand. One of the keys to that, and one of the ways that I think that that oil share has been muted, or the market has kept oil share muted, in part because of weakness in non-biofuel demand. And if we have this kind of soybean meal demand, and so that implies in and of itself basically record crush, then it may be that that sort of setup can continue if our domestic meal demand forecast is correct. If it's not, if domestic meal demand is going to be weaker than we expect, then I would expect that oil share will reach the 50% level, and all of the things that I've talked about will happen earlier than the end of 23, 24. Again, I can kind of see all of this in the spreadsheets. The reason that I am hesitant or less confident is only because I've been able to see all of this in the spreadsheets for the last couple of years, and the market has sort of stubbornly stayed where it has been for my entire career, essentially, which is soybean crushers crushing soybean for soybean meal, and then doing what they can with the oil. It will change, but right now, at this moment for 23, 24, I'm not 100% sure that necessarily is a change that we're going to see in the next marketing year, in the next 12, 11, 10 months. The other thing that I would point out in terms of the confidence in this forecast is while the September crush came in, 92,000, or the September demand came in around 90,000, a little above 90,000 tons a day, the implied domestic demand for October is 114,000 tons. So much closer to where we've been. Of course, as you can see in the chart, there's a very strong seasonal for really strong demand in October, and then it kind of slows through the rest of the year. So it'll be December 15th when we get the next edition of the NOPA report, and that'll be our first indication of whether we think this setup is going to continue throughout the year. All right, on to what the EMTS report said. So if you look at biodiesel production and biodiesel imports, you can see that the supply of biodiesel into the US remained really robust in October, just below sort of just below the peak, which was May, and maybe just a touch below June, but certainly in line with those two. Imports have been particularly strong in the last couple of months, really throughout the year, but in particular, in the last several months outside of July, imports have been really strong. And we've taken our import forecast up a little bit. The import forecast, by way of comparison, is roughly, it's between 400 and 500 million gallons for both biodiesel and renewable diesel. It hasn't changed dramatically, so it has risen as a result of the strength in US imports, but it's risen from 450 to 500 or something like that. So it's risen, but not so substantially that it makes a difference in the larger kind of overproduction of D4 RINs relative to the demand. I don't know if that's occurring because importers think this is, we only have so much time before we don't qualify for the blender's tax credit, or it won't be the blender's tax credit at that point, it'll be the Inflation Reduction Act credit. And so they're trying to push as much biodiesel into the US market as they possibly can. That kind of makes sense to me from just kind of that makes sense because there are very few markets that are as rewarding as the US market in terms of financially. However, there are some other markets, but still I think that biodiesel producers probably on some level are, we only have so much time, and so we need to get as much into that market, or we need to take advantage of this situation while we can. You can see next year we've got imports down a bit, and it remains to be seen whether we'll have to adjust that higher. The same with our biodiesel forecast, domestic production forecast. I still am struggling a little bit with exactly where to set that. With each passing day, I get more drawn to basically the argument that biodiesel capacity probably doesn't shrink that much, and it finds niche markets, or at least it doesn't shrink that much until we get to 2024. Like I said last week, past 2024, when we get to the IRA credit, that potentially could be, it certainly will have a significant impact on the industry. Whether that entirely cuts off US imports or just has an impact on some imports remains to be seen. I think part of the reason that I hesitate on a question that seems like it should be obvious, so it seems relatively obvious that if you cut the blender's tax credit, that US imports are going to drop really, really significantly. My hesitation only comes from the fact that if you look at canola oil or soybean oil and the Inflation Reduction Act credit, as we talked about last week, it would imply the exact same thing. And I'm not 100% sure that I think that that's going to happen, that we're not going to use soybean oil in the production of biofuels anymore, because it just becomes extraordinarily difficult to produce enough biofuel to meet the mandates without using soybean oil, which accounts for more than 40% or roughly 40%, depending on which month you look at, of the total feedstock supply. And so if you kind of take that same logic and then apply it to imports, there's no good reason to say that imports will be anything other than zero once the Inflation Reduction Act kicks in. But again, if you have 1 billion gallons of supply coming from biodiesel and renewable diesel imports, then that 1 billion gallons is going to be tough to replace, especially if you're not using soybean oil as a feedstock domestically. So I think that you probably ultimately will see some kind of offset for the blender's tax credit in the price of RINs, and that the whatever portion of that credit is lost in aggregate because of the reduction in the payment to producers that use soybean oil or imports. RINs will need to offset that to encourage the supply that will potentially be lost. That's one way to go with the forecast, and based on just the pure economic analysis, that's the way that suggests it should go. Things don't necessarily always work out the way that the economic analysis suggests. And so that is our hesitation in making a strong statement one way on or the other on US imports or US soybean oil usage. We've kind of taken the middle road, which is generally not the best way to go because it sort of ensures that you're wrong. But as we get closer to the end of the blender's tax credit, we will certainly flip that coin and land on one side or the other. At this point, I would say that I would land on we're going to continue to use soybean oil and going to continue to have imports side of the coin, just because it starts to become so difficult to make up the volumes that would be lost if we didn't have those. For renewable diesel production, you can see a tick down from August and September. That's due partially, I'm sure, to the sharp decline that in our estimate of renewable diesel margins, which dropped just under $1.50 for the month of October, from an average of about 205 or just below 205 in September. So this kind of makes sense. It remains to be seen whether we'll get this tick up that we've got built in December. Unlike biodiesel, where the seasonal pattern in renewable diesel isn't quite as strong, the one thing that you can count on is that it seems very likely that year over year you'll see an increase, and potentially a substantial increase, although we had a pretty big increase last November. And so the difference between last year's November and this month's production might be smaller than it has in previous months. And then the open question on what's going to happen in December. There have been sort of anecdotal reports suggesting that some of the pre-treatment problems that we've seen are starting to fade a little bit, and some of the producers that have had problems with their pre-treatment will be at full production by the end of the year. And so that's a little bit of what's behind our December forecast. I'm not 100% sure that I again fully believe that is going to happen and that's where we're going to be. If we get a bump in margins, then I'll be a lot more confident in that. If we don't see margins start to come up a little bit in December, we probably will cut our forecast as we go through the month. So what does that imply for our total production forecast? It's basically unchanged from last month. We added just 12.3 million gallons of production across all of the fuel categories based on the October report. That was mostly due to slightly lower production than expected in D3, D5, and D6. For D4, we actually added, I think, about 25 million gallons or so to that. Again, just sort of based on what we see seasonally, not at all based on what we think production is relative to the mandates. As we get into this time of the year, the seasonal, especially again for biodiesel, becomes much stronger. And if we look at sort of the implied December production relative to the month before, we look at the last quarter compared to the third quarter, those kinds of measurements are generally what we use to set our forecast for the last couple months of the year. And so we tend not to change too much at this time of the year, in part because we already have 10 months of data. And so it's hard to change it enough to make a significant difference anyway. There is one thing that I sort of noticed that I guess I hadn't noticed or thought about before. When I put this slide together, I put in the 20.6 billion gallons, and I thought, that doesn't seem like that is as high as the mandate, the total mandate. And I looked, and sure enough, the total mandate was 20.9 billion gallons. So we are predicting a shortfall in RIN generation of 300 million gallons. That seems odd given what we've seen happen with RINs, until you kind of think about it this way. One, there's a huge carryover from last year, or a carryover from last year that'll be multiples of that 300 million gallon total, even if it is just, even if we carried over less than 1 billion RINs last year, that would still be 3 times the total additional RIN generation that we need relative to the mandate. 2, the mandates are a function actually of fuel consumption as opposed to the absolute volumetric number that the EPA publishes when they publish the mandate. And so they can change throughout the year, and it may just be that consumption of liquid fossil fuels has come down enough that the actual mandate, instead of 20.9, is 20.6. Those can both be true and likely are. There's also a little bit of I'm talking about gallons and sort of mixing that in with RIN generation. And of course, ultimately, the way that obligated parties comply with the RFS is through RIN generation. And so the RIN mix might be slightly different, and we may actually generate enough RINs to meet the mandates, even if we produce a little bit below the implied mandate based on gallons. And that would sort of work like this. If when the EPA sets the mandates, they assume that biomass-based diesel production is going to be whatever it's going to be, let's just say 2 billion gallons. And the average RIN per gallon is something like 1.55, let's say, for biodiesel and renewable diesel. And then we produce a lot more renewable diesel than we expected, or the EPA expected, or anybody expected. And so the average RIN per gallon of biomass-based diesel isn't 1.55, it's 1.6. Then you would actually get sort of, not necessarily, you could have the same number of gallons produced, but have more RIN generation. And the 20.6 and 20.9 are close enough that might also contribute a little bit to the shortfall. Either way, given the fact that if you look at the mandates based on total production and aren't just focused in on the D4 relative to the advanced mandate, or the D3, D4, and D5 relative to the advanced mandate, like we have been for most of the year, it would be a little bit surprising that RIN prices have done what they've done. However, um, given what we expect in terms of overproduction of D4 relative to the implied mandate, which includes both the undifferentiated advanced and the ethanol shortfall, that says we're going to overproduce by almost 900 million gallons. And so the pressure on RIN prices really is coming from the D4. And this is why, several months ago, I guess at this point, probably, I kind of just wondered out loud, could it be that the D6 would trade below the D4? And I've done a little bit more digging, and there actually was a time that the D6 did trade above the D4 a couple of years ago. If you go back through the EMTS data, you can find that. And that could be important this year. It doesn't seem like it's going to happen again, but given the divergence between overall RIN generation and the RIN mandates and the D4 RIN generation and the implied mandate for D4, those two things would, at the very least, as they have, really narrow the spread between D4 and D6 to historically low levels, which it is. But it also ultimately could mean that if we get down to the end of the year and somebody needs RINs for compliance and they can't necessarily use D4 RINs, we might see a short period of time where D6 actually trades above D4. I wouldn't predict that, and if you see that predicted in our RIN forecast, you can think of it as an error rather than us going out on a limb. But it's important to note that it's a possibility, and it also sort of explains the difference between the production relative to the total mandate and the production of D4. I don't necessarily think that in the short term that this means RINs bounce back up to $1 or something like that. I think much more that to the extent that this will have an impact, it will be on the it will be for a very short period of time, probably in December, and you'll probably see D6s trade a little bit above D4 and then, or maybe a lot above D4, but for a very short period of time. And then the market comes back and does what it normally does, which is D4s above D6s. I would note that since the last time I showed this chart, the overproduction has gone up by 23 million gallons. Again, a little bit of that is just from this month, where because of the shortfall in D3 and D5 production, the implied D4 production has gone up. Probably next month when we get the EMTS data, I'll go through the D3 and the D5 production. I know that's not necessarily the categories that are what a lot of people on this call will trade or be extraordinarily interested in. However, I think it's important, particularly the D3, for the next couple of years to understand how that's growing, why that's growing, and what's the potential for it to continue to grow. Because if D3 didn't make the mandate that they set for it this year, they have relatively aggressive targets going forward. And if it can't make it this year, it seems unlikely that it'll make it next year. And that could soak up a significant volume of the billion gallons of production that we think, or that we're predicting will, the billion gallons of overproduction we're predicting for 23 or for 24. That was tough. And the ethanol mandate relative to our expectation for production, that is up slightly from last month. 13 million gallons on the how much biomass-based diesel do we need to produce, and that is I can't do the math in my head that quickly, but it's not much. It's 20 million gallons or so, 25 million gallons maybe, of additional shortfall relative to the mandate. this one, I think there is probably an economic incentive to produce a little bit more ethanol. Blending has looked relatively attractive in recent months, and so it may be that this starts to narrow up. Ethanol production in October was a little stronger than we expected, and it removed enough of the sort of December balancing month for us that we smoothed it out. But I probably would, if we see something similar next month, I probably will raise our expectation for ethanol production, which will narrow this. It will also narrow the implied volume of biomass-based diesel that's required to meet the advanced mandate and then the overall mandate. However, either way, it doesn't seem like the economics are so strong that we will get rid of these anticipated significant gaps between the U.S. ethanol supply, domestic production, which is 99% of the total, and imports relative to the EPA mandate. All right, and then the final chart I wanted to show is another one of these charts where I probably have put too much into one chart. But I wanted to kind of show where jet fuel production is. SAF is something that the industry is really interested in. We get more questions about it every day. And so I kind of wanted to put this up here for a couple of reasons. And what this is it's a stacked area chart of the various categories of jet fuel production that the EPA reports. So jet fuel production domestically under the D4 plus domestic D6 plus imports in D4 and imports in D6. And so that's the areas, and those are stacked on top of each other. So the production in March of 2022 was just under 3 million gallons. On the right-hand scale, we have my favorite fuel category, which is the domestic 1.6 RIN per gallon category that, as again shown in this chart, was basically zero for a very long time. It was actually, there was some production and then it went back to zero. And then over the last several months, it has shot up to basically a little bit more than 50 million gallons a month. If you look at the pathways, there's some question about whether this production is renewable naphtha or renewable aviation fuel. And while the pathways tell you that, it was never clear to me that I could say with any confidence that it was one or the other, unless I really got some insight into one, U.S. renewable diesel imports, and then two, who was actually generating those RINs. However, if you look at the jet fuel production against this production, you'll see that the 1.6 RIN domestic renewable diesel category tended to have a little bit of production during months that the normal jet fuel categories spiked their production, which implies that jet fuel production was profitable in that month. And so not only did you get sort of the normal categories, but you also got some production from this other category that the only reason I would think it was jet fuel is because the other production categories kind of spiked, implying that the economics supported jet fuel production. There are a couple of companies that have pathways approved to generate 1.6 RINs per gallon. One of them essentially produces renewable naphtha, and the other is set up to produce aviation fuel. And if we include this total in aviation fuel, then aviation fuel, if we include the whole thing, aviation fuel looks like we're producing nearly 50 million gallons a month. If we don't include it or only include part of it, but let's just say we don't include it, then renewable SAF production or SAF supply in the US is less than 5 million gallons a month and really less than 3.5 million gallons a month for most months. The other thing is that, like back here when production, like early 22, when production under the 1.6 RIN category was relatively low, but also seemed to match up with the spikes in jet fuel production. You do see some of the spikes in that category matching up with increases in the reported categories. It doesn't match quite as well, and there are some imports in there that look a little odd, or some imports in there that contribute a little bit, though they don't really show up here. It doesn't make a ton of sense to me. Anyway, it doesn't seem quite as clear for recent months as it did in the past. I'll keep talking about this. Probably I'm the only one that cares about this, but I think it's interesting, and I think it will become more important as SAF production becomes more important and more a focus of the industry. Sort of, at least at the beginning, when supply is so low, figuring out whether the supply for the US is actually 3 million gallons or 53 million gallons will have a big impact on how quickly the reported categories ramp up as SAF production becomes more widespread and SAF usage becomes more widespread. If we're already absorbing 50 million gallons of SAF production a month, that looks a lot different than if we're just absorbing 3 million gallons of SAF production. So that's really why I showed this. The category is interesting just from the fact that there aren't many where you just had no production and then you ramp up to 50 million really quickly, and just kind of from the puzzle of it all. But in the longer term, it's probably not so important. But in the shorter term, I think that it is important to understand this, just to kind of understand where we are in like I said, in the development of the SAF industry. All right, with that, I will take your question. Somebody's got a question already. Still didn't make my time. With meal, 80% or so of the crush and a scenario of depressing pricing for meal that you seem to be painting, how high does oil need to price in order to support crush economics? So this question really comes down to sort of where does the oil share need to go? And I sort of think about it this way, and hopefully this will answer your question. If you think about the oil share as what determines whether crusher is crushed for meal or crushed for oil, there's one key difference between the two products, and that is how long can you store oil versus how long can you store meal. And so traditionally, like I said, crushers have crushed to meet meal demand, and then they've stored the oil, and because they could store oil for a couple of years, it didn't necessarily have to come out into the market and depress prices in the same way that meal will, because you can't store meal for that long. And so oil share is going to need to move higher, and that then will support the crush economics. It doesn't necessarily mean that crush margins will remain exactly where they are if oil goes to 50%. However, because of that difference in the storability of oil relative to meal, there's an argument to be made that at 50.1%, crushers still aren't necessarily crushing to satisfy the oil demand, that they're still crushing for meal because you can't store meal as long. That's going to depress prices. And so oil share actually needs to rise above 50% to some level to actually get that switch done. On a just a pure price how many cents does oil need to rise to offset 1 cent of decline in soybean meal prices. I haven't done the side-by-side math exactly, but if generally, and I think you're well, generally if meal is roughly 80% of the volume that comes out of a soybean, and oil then is the other 20%, then you would roughly need an increase that was 4 times as large in soybean oil to offset the decline in meal. Now, that won't actually work out on a one-to-one basis because meal is priced in short tons and oil is priced in pounds. And so you have to do the conversion from 2000 down to do that. And then that makes it more complex than I can do in my head. But that's something that is a question I should probably have a standard answer to. So let me go through and do that. And in a webinar relatively soon, I will show you sort of exactly how that works and how much soybean oil needs to go up to offset every penny of, or every dollar decline in meal demand. I also what I would say, without talking specifically about crush margins, or specific crush margins, is that I don't necessarily think that the real pain of falling crush margins is going to be in the U.S., because you'll have a big you have a relatively large premium either in the cash oil markets, either for crude or for RBD, based on this growth in demand. And so that will help offset a lot of the whatever the decline is in protein meal prices. If you are an Argentinian crusher or you are a Brazilian crusher, less Brazil, more Argentina, because they rely a lot more on the export market. I think that's where you're going to see the real pain. And so I think that Argentinian crushers are going to need to find ways to get US buyers excited about Argentinian EPA certified soybean oil to narrow the difference between export prices in Argentina and export prices at the US Gulf, domestic prices in the US, and limit the impact on their margins for the pressure that's coming to the protein meal market. So in the US, it will obviously have some impact on crush margins, but that will be mitigated and perhaps entirely mitigated by strength in RBD prices or crude soybean oil prices. However, outside of the US, that's where you probably will see more of the pressure on crush margins. And of all of the countries outside of the US where we pay attention to crush margins, Argentina would be the country that I would think would have the biggest problem. You mentioned that RVOs can decline if fossil fuel consumption declines. Can RVOs also increase in the same way? Yes. So what happens is that, excuse me again, the EPA sets and announces these volumetric mandates. And we all use those to try and estimate production and feedstock demand and all of that stuff. What happens in terms of actual compliance is the EPA doesn't tell obligated parties, you have to blend 50 million gallons of ethanol. They say you have to blend 10% of your gasoline sales with ethanol. And because of that mechanism, the effective mandates or the real mandates can either rise or fall relative to the announced mandates. And maybe that would be something that I could also talk about in future webinars and kind of show you where that has been historically relative to the announced mandates and where it is this year relative to the announced mandates. I think the primary example would have been 2020 or 2021, but the EPA went back and sort of set those equal to production. But we can look at that and see if that shows us something interesting. But the short answer, which I turned into a long one, is yes, it can. All right, thank you for the awesome questions, and thanks for your support. I will see everybody hopefully next Tuesday. Have a great week. Bye-bye.